Welcome back to the channel. We are adding on and continuing to share with you the different positions in our portfolio. And if you were watching this video at the time of the drop, this stock market is a little bit of a mess right now. If you are new to investing, I want you to think of downturns. It's almost a catch-22 because, of course, your portfolio value is going down. Our portfolio is down significantly. At the highs, we had just gotten a little bit over $100,000, and at the time of this recording, we are right at the tip of $80,000, possibly going to be dropping below $80,000. So we're talking $25,000 drop, and through that period, we have been adding money into it. And so these type of downturns are very hard because mentally you're going through, I'm losing money. And you have to remind yourself, you're technically not losing money if you haven't sold. As well as, I want you to think about this in the sense of, especially for those who possibly have started later. If you have started later and missed some of that upside, and then the stock market falls back down, you're getting an opportunity to buy shares at, let's just say, so some of the ETFs we're purchasing, that we purchase or buy on a monthly basis are back to, like June of 2020 levels. So it had downturned and it had come up, but I am able to buy back 2 years of time because the stock price has fallen back down to that price. Yet I have even more certainty because these companies have bigger earnings than what they did back in the second, third quarter of 2020. So it's almost like an insurance policy because I have insurance that people were buying the shares in the stocks when it was up here and they had, quote unquote, this amount of earnings potential. But then we have had a year and a half of earnings growth, yet the price has fallen back down. So it takes some time. It's not easy to do. It is very hard. Our portfolio right at the beginning of November had just reached a little over $100,000. And as I record this today, we are barely a couple $100 over $80,000. This portfolio has fallen $25,000, and we have been putting in $3,300 a month in December and in January. I'm about to be doing it again in February. So this is not easy, but I have been starting a series of introducing you all to all of our investments. This is one of our another one, IYC. I did QCLN, I did SMH. CMBS, and now IYC. So let's not waste no time. Let's get right into it. So why do we own IYC? IYC is the consumer discretionary. So wherever you think you swipe your card at, most of the time, those particular companies are in IYC. It is every type of product you could think of. I got here listed: home products, general products, car manufacturers, clothing, fast food. Again, wherever you spend your dollars at, from the Home Depots to the Costco's to the Walmarts to the Targets, to the Ford manufacturer, it is in some form or fashion in this particular ETF. And that is why it is a career-long investment for us to be in IYC. And as these companies turn, companies go out of style, go bankrupt, new ones come in, there's always going to be a place for consumer discretionary spending to be hopefully in your portfolio. And that is why I like IYC. As I have mentioned in the previous videos, if you have watched them, SMH, QCLN, and cannabis all received $8,000 at the beginning of the year, as well as 2 other in our growth portfolio. Then we had 5 particular ETFs that got $2,000 a year, and this was one of them, IYC. So in January of 2021, a year ago from this time, we put $2,000 into IYC. And at the beginning of the year, when we had a different portfolio allocation, we used to do $200 a month. And so probably about midway through the year, of 2021, we upped that to now $300 a month, and that's currently what we do as of today. Every single month we get $300 and we put that into our particular ETF. It has an expense ratio of 0.41%, which is kind of in the middle of the market. We have a little bit, or some that are as high as 0.75, and then some as low as 0.08%. I think Fidelity has a couple that are 0.08 that we own. And so, like I said, IYC is right in the middle at 0.41. I believe iShares, yes, this is iShares. IYC is managed by BlackRock. So BlackRock, this is one of BlackRock's ETFs that they have for their consumer discretionary. And so, some of the major holdings are your Amazon, your McDonald's, Netflix is in there, Tesla. Again, where you spend your money at on a daily, weekly basis, I guarantee you, this is, or in your daily routine, in your weekly routine, you will spend money into this, a particular ETF. And this goes into the concept that I want to speak about is why it makes it a little bit easier to own some of these ETFs going through tough periods like this. Again, when you see IYC and you see IYC falling down, and then you look at the companies that that are in this, so the Amazon, the McDonald's, the Netflix, the Teslas, it's easy for me as an investor to just look out into the world and ask myself, does it look like Amazon is slowing down in any kind of way? I still see Amazon trucks out on the roads every single day. When I drive by the McDonald's, the fast food lines are full. When I go into Home Depot, everything is transitioning over into self-checkout and the lines are as long, so payroll's getting cut back. Product is still being moved and shipped through. I see Teslas all over the world. So this is a way to get research on your investments without really doing any research. It makes it feel a lot more comfortable when I'm purchasing these ETFs and they're down 10, 15, 20%. And I'm looking out into the world and I still see them operating and doing business. It is just a nice way that, yes, even though the value of the position is going down, I know those companies are still operating and still making money. And so that makes it easier for me, at least, to invest in these companies when we're going through tough patches as the ones that we are now. And so the role in our particular portfolio is just a defensive role. Again, I keep kind of coming up with these roles, and I believe either SMH or QCLN, I spoke on this concept of almost a soccer team. And on a soccer field where you have your offense, you have your defense, and your goalie. And each one of our positions kind of plays a different role. We have ones that are a little bit more offensive, a little bit higher returns on a year-on-year basis. And the defense is just to almost provide a little bit of a support to our portfolio. And then the goalie is the floor. That's going to be the dividend ETFs. That's going to be the ones that I don't want to say the guaranteed, but the guaranteed 5 to 8%, 8 to 10% every single year, no matter what. This one is the defense. You're not really seeing humongous growth because the industries are all pretty much pretty full, but you're getting that year over year 10% growth that we like to see, and allows that ETF over a 15, 20 year period to have nice returns, especially when that capital that you have put into that investment is large. And so, that is the role that it has in our particular portfolio. It's the ongoing consumer spending. So, again, folks are always going to Target, folks are always going to Walmart, Costco, always buying a car. Amazon is constantly, moving throughout our communities. Netflix is growing year over year. And so that's where these holdings that are within IYC are really starting to expand and whatnot. It's a long-term play. This is the play that, again, for us is a career investment, something that we're going to be investing in for 20 plus years, 30 plus years, and looking to get that 10%. Right now, it's not big. 10% on $10,000 is only $1,000. But once this portfolio in 20 years or so grows to a $500,000, $700,000 position, and now we're talking 10% on 70,000, on 50,000. Now that's something to talk about. That's a part-time job salary. That's a full-time job salary for some individuals. And so that's where we really want this portfolio to get to, and then provide that consistent returns at that particular time of our investing career. So IYC is a great one. Take a look at that. For your particular portfolio, see if it might have a place, a allocation that you can make for it, and hopefully you can find success with it in the way that we have. Thank you so much. Subscribe to the channel if we have been providing you value, and look forward to seeing you on the next video. Thank you.